All right, let's dive right into a really powerful real estate investment strategy that some of the most sophisticated investors are using to get a piece of some seriously large deals. So let's start with a big question. What if you could own a massive apartment building and get all the financial upside, but without any of the headaches? No calls about leaky faucets or tenants who won't pay. Well, it turns out for a lot of investors, the answer is a resounding yes. And the way they do it is through something called a real estate syndication. It sounds complicated, but the idea is actually pretty simple. It's basically group investing. A whole bunch of investors pool their money together to buy a huge property that none of them could afford on their own. Now, at the heart of every single one of these deals, there are really two distinct rules. You've got the operator and you've got the investor. And understanding how these two work together is absolutely key to the whole thing. And this really shows you that division of labor perfectly. On one side, you have the sponsor. Think of them as the captain of the ship. They're the ones who find the deal, they put it all together, get the financing, and manage the whole operation. And on the other side, you've got the limited partners. They're the investors. Their main job is to provide the cash to make the deal happen. So let's talk about the money. How does a massive $30 million deal actually get funded? Well, typically, the sponsor goes out and gets a big loan from a bank. Let's say 20 million bucks. That leaves a $10 million gap, right? And that's where the investors come in. That equity is raised from all those limited partners. Okay, so what's in it for the investors? What are the perks? As you're about to see, it's a whole lot more than just getting a little slice of the rent every month. Well, the biggest one for a lot of people is that it's completely passive. I mean, you invest your money and the sponsor does all the heavy lifting. But beyond that, you get access to these huge institutional quality buildings that you could never buy yourself. And since it's a real physical asset, it can be an amazing hedge against inflation. But this is where things get really interesting. We're about to look under the hood at the hidden tax engine that powers this entire strategy and how real cash profits can actually turn into losses, at least on paper. You see, this whole structure opens the door to some major tax deductions. You've got the usual stuff like mortgage interest, but the big one is depreciation. And there's even a way to supercharge it using something called a cost segregation study, which gives you even bigger deductions right at the beginning. Depreciation is really the magic ingredient here. It's what's called a non-cash expense. It lets you write off a piece of the building's value from your income every single year. And the wildest part, you get to do this even if the building itself is actually going up in value. And just look at what that does. It's kind of mind-bending. An investor might actually get a check for $8,000 in pure cash profit. But when it comes time to file taxes, after you apply that big depreciation deduction, it looks like you actually lost more than $21,000. Okay, but, and this is a really, really big but, there's a major catch. There's a rule that stops most investors from using these amazing paper losses to their full potential. So here's the wall you run into. Because you're a passive investor, a limited partner, the IRS says these are passive losses. And the rule is simple. Passive losses can only cancel out passive income. They're stuck in the passive bucket. You can't use them to lower the taxes on your main income from your job. That's in the active bucket. This all leads to a really fascinating question though. What if there was a way to legally break down that wall? What if you could take those massive passive losses and move them over to wipe out the taxes on your active income? Well, it turns out there is a way. It's a special designation from the IRS, and it's called Real Estate Professional Status, or REPS for short. And getting this status fundamentally changes the entire tax game for you. Now, to get it, you or your spouse, which is a key detail, have to pass two main tests. First, you've got to spend at least 750 hours a year working in real estate. And second, that real estate work has to be more than half of all the work you do, period. For the people who can check those boxes, it's an absolute game changer. Suddenly, those paper losses from the syndication aren't passive anymore. They can flow right over and directly lower the taxable income from your main career, and that can lead to some truly massive tax savings. So let's wrap all this up. What's the big strategic takeaway here? Well, you shouldn't think of a real estate syndication as just one thing. It's more like a tool, a really versatile one that can be used in totally different ways by different people. Here's the bottom line. For a regular passive investor, a syndication is a fantastic way to get cash flow and watch an asset grow. But for that person who qualifies as a real estate professional, it becomes something else entirely. It becomes a precision instrument for actively slashing their entire tax bill. Which leaves us with one final thought. Is a real estate syndication a passive investment, or is it an active tax strategy? Well, as we've just seen, the answer to that question depends entirely on who you are.